Hey everyone, thanks for watching. Really excited to have our fourth and final guest of the week for our weekly conversations about real estate investing. Let's welcome Matt Seamus to the show. How you doing, Matt?
Hey, Michael, I'm great. Thanks for having me.
Hey man, no pressure, but you're bringing us home for the week. We do these Monday, Tuesday, Wednesday, and you're the cleanup hitter. So no pressure.
Okay.
You can handle it, right?
All right. I got ice in my veins here.
There you go. You're D'Angelo Russell, ice in the veins. I like it. I like it. I like it. So why don't you just quickly remind the audience who you are, where you're at, what you do, and we'll get into some questions I actually got from subscribers.
Yeah. So my name is Matt Seamus. I run Driven Capital Partners. We're a boutique real estate private equity group. We buy commercial properties, improve them, and try and give our investors really good returns. And I'm based in California. I'm in Los Gatos, so not too far from you.
Yeah, I don't know. By the way, the car drives 20 minutes apart. So I appreciate you.
Well, it depends on traffic.
Yeah, that's right. Yeah. 5:30 on a Monday, not 20 minutes. It's probably like 2 hours. All right. So I got a bunch of questions. We're gonna try to tackle these. If they're 10 minutes long, if they're long, whatnot, we'll just go for it. But given what's going on in the world, and really we have different businesses, I thought it'd be interesting for both of us to tackle this question, right? How does war slash geopolitical uncertainty factor in your investment thesis? What do you think about it? Is it top of mind just given the last couple of days? You've been doing this a while. What do you think? How do you look at that?
Well, yeah, this is an interesting question. I'm actually interested to hear your thoughts on this too. I think as a real estate investor, it's prudent to be following world news and just what's going on kind of geopolitically. So I think the first thing is you kind of want to know what's going on, whether you're actively investing yourself or whether you're passively investing. I think it's just important to know, kind of, to have your finger on the pulse a little bit.
Mm-hmm.
I think it's easy to overreact to headlines.
Mm-hmm.
I mean, and I think that you don't. Real estate is local, right? You know this. I mean,
Mm-hmm.
it's not. You can't say when someone asks what is the real estate market doing,
Yeah.
that doesn't mean anything, right?
Yeah.
So
It's like what?
yeah. So are you talking about single family housing? Are you talking about industrial space? Are you talking about interest rates and how that's affecting housing inventory? There's so many different things to think about. So you can't just take a headline and extrapolate that into some action to me.
Mm-hmm.
I think you need to. Now that being said, what I've seen recently is so I was looking at my equity portfolio this morning because I'm very interested and curious and a little bit nervous about what's going on in Iran right
Mm-hmm.
now,
Right.
and also what's going on in China
Mm-hmm.
in relation to the U.S. in particular.
Correct.
So what's curious to me is how that affects dramatically the stock market. And so Trump signaled that the U.S. was no longer going to do anything further with Iran. I think last night or this morning he signaled that.
Yep.
And look what happened to the stock market this morning. Everything is up. Everything is green, and the Dow is like testing new record highs. I think that's really interesting. The stock market jumps really. It jumps a lot with headlines and with tweets and things like that. One of the things I love about real estate is it doesn't. It's slower moving. It's dumb. That's what I like about it
Mm-hmm.
because if I own a property, I am in much more control over my property and my asset than what a headline might suggest. And so I think about. I like to understand what's going on in the world. I want to know.
Mm-hmm.
It certainly has implications. But at the end of the day, one of the main characteristics of real estate that I love is I get to control it. So I don't know. That's kind of how I think about it.
Yeah, so it's interesting. We sort of similar sort of thesis. I watch and actually have one of my playlists on this channel is daily financial news because I've been looking at daily news headlines for nearly 2 decades now. And I've just started sharing my thoughts. But the reason I do it is I'm just trying to track two things. One is I'm trying to read the tea leaves to see what's going on with the consumer. Why the consumer? Well, it's because the consumer, at least in my world of, mom and pop, single family, small multifamily, they're my number one competitor, right? They can come in with the least amount down, right? 3.5% FHA. They can frankly overpay for something that I might want because my numbers have to be more conservative as an investor. My capital is larger, usually 20, 25, 30% down. So I'm trying to figure out all the time what's going on with the consumer. And sometimes geopolitical events can scare the consumer. Not always, but I remember several times during the last 20 years where there were months where you would see cancellations of contracts at higher percentages because people got scared. So I am absolutely looking at those. But again, it's kind of that ripple effect, right? It is sticky on the downside. It is definitely not headline, but I'm trying to read ahead, right? Okay, is this going to be something bigger? Is there going to be, loss of life? And is it going to, is it something that's going to take the mom and pop on 123 Main Street and make them nervous?
Yeah.
If the answer is yes, months ahead, I believe there will be cancellations of house purchases because it's the largest investment out there. And, typically that means I can offer less or at least not have as much competition. So that's the first thing I look for. The second thing I look for is kind of the flip side, and that's the cost of capital, right? My greatest expense every year when I file my taxes is interest, right? So if I can find a way, or it looks like interest is going to become cheaper because people are scared, they're running into bonds and gold and oil or whatever it is, they're out of stocks, that, is good for my business because it gives me at least the opportunity to get cheaper debt on new purchases. Or if I like, it gives me the opportunity to refinance if that's something that I've been thinking about. And again, the portfolio that, I'm still a mom and pop investor, but I'm a medium-sized mom and pop investor. So, I can strategically plan out my refis, whether they're just rate and term or if they're cash out. So those are the two things I'm looking at. And I do believe geopolitical events, especially in today's worlds of tweets and social medias, can absolutely freak out the consumer. So those are the things I'm looking for in those things. But yeah, that's so I certainly think it's something you need to watch that. And that's how I use it.
So you mentioned interest rates. What do you think happens with interest rates in the next, I don't know, year, 12 to 24 months?
So so 12 is a lot easier to say, obviously. I don't think the Fed moves. I don't think the Fed goes up or down. So the Fed's flat for the year. And most of that, in my opinion, is because of the election, right? If the Fed was going to raise or lower, in my opinion, they'd have to do it by June because there's no chance in heck they were going to want to be seen to influence the election in November. So that's just the way it rolls, right? It's been the same way for every election. So this is no different. So that's that. Now, next year, 21, frankly, that's all going to depend on who wins the House or who wins the election, right? Who's in the White House, right? Not the House of Representatives, but the big house, right? Because I believe there's a chance that if some of the candidates win, that we could see a significant haircut in the market and see growth fall off a cliff. So we'll see. I'm not claiming anything for 21 because I got to see what happens in November. But that said, even if the Fed doesn't move, I do expect interest rates on 30-year, 15-year, loans that you and I get, they're going to tick a little higher, but not meaningfully. Probably, I would guess they're going to be within a band of certainly less than a half, right? They're upper and lower, a half is what I'm thinking on for 2020. You?
Yeah. Yeah, I think that. Yeah, I think I broadly subscribe to that. I think. Yeah, I don't think I would have anything to add. I think that's right. I try not to. I try to take in information and make decisions. I'm not a great speculator of what's going to happen, but I would say what you laid out is probably reasonably likely, highly likely.
Yeah, and the beauty about what we do, again, because we're not stock pickers, we don't have to aim for the absolute top or the absolute bottom. We can, we're going to be okay, right? Our vision is longer than 2 seconds, right? I think in decades. Everything I buy, frankly, everything I buy, I plan to keep forever, right? If it goes in my buy and hold portfolio, I assume my daughter's going to get it when I'm dead. Now, does that always happen? No, because I like 1031 exchanges, and sometimes the market gets stupid and wants to overpay. And, you know, I'm not opposed to selling. If the market wants to give me 200 grand for something that's worth 125, I'll sell, no problem. So, you know, we will see what happens. All right. So that's that question. I like this. This next one's going to be fun. How do you think about liquidity? Where do you store cash and how much? What do you think about that?
Interesting. So this is a topic that I think about a lot. And I would say that I do not have this figured out. You're always playing an opportunity cost battle here, which is you need cash, you need liquidity to be able to buy, renovate, improve, get properties into contract, you know, the at-risk capital to go through due diligence, spend money on appraisals, inspections, et cetera. You need cash to do those things.
For sure.
On the other hand, any cash that you have is almost by definition being underutilized in the sense that it's not achieving a high yield or any yield at all.
For sure.
So you want to have enough cash to go achieve your goals over the next, you know, call it 3 to 6 months in terms of acquisition goals. But you don't want to have so much cash that you are diluting your overall portfolio return and just leaving opportunity on the table.
Yeah.
So the way that I think about this is I like to have a good chunk of liquidity, but I keep it mostly in 28-day T-bills.
Ah, okay.
So I have a brokerage account. I have some equity investments in that brokerage account, which I am over time reducing and moving money, more and more cash into real estate. And then I have 28-day T-bills, which effectively are the shortest version of government, treasury bills, right? They pay somewhere around 2% a year.
Yep.
So right around, maybe approximately around inflation, maybe a little bit more than what the government says inflation is. So you're not losing money. It's not like you have cash stored under your mattress, losing value. Yeah. They're relatively liquid. You can move in and out of them with some minor penalties. Yeah. And so that's kind of where I hold my cash.
Okay.
And try and keep enough available for, like I said, making the next acquisition and doing what I need to do in my business.
Yeah. So it's funny this question came up because my answer is very different today than it would have been any other year of my investing career. So let's answer it that way. So for the first 19 years of my investing career, actually, let's say 18, right? So before I retired, if I got to, let's just call it 40 grand of cash, 50 grand of cash, I would get nervous because I was thinking the opportunity cost of that cash there. Because I had a W-2, my wife had a W-2, right? Our bills were frankly already paid by our rentals. So I was always like, get the next one, get the next one, get the next one. But now that we're done and we're repositioning equity and debt and all of this, I treat, it's very different today. So first and foremost, I have a pile of reserve cash sitting in a separate account. It's just in the savings account. It's X dollars amount. It's 20 or 25 grand sitting somewhere else that I don't touch unless there's one of those events in being a landlord, right? Oh my God, a roof just leaked or a tree fell on a house or whatever, right? You got to pay a $5,000 insurance premium or a deductible, because of something, right? So I have an account and I've always had that, right? That's always separate. I believe in having reserves. You don't touch them. You don't use them for deals. You don't even use them for deals of a lifetime because you just never know with real estate, Murphy's Law and all of that. So that's I have that pile and I've always had that pile. But now as far as, I have more cash now than I've ever had. And it's because I believe we're at the top of the market. I joked earlier about selling stuff that's overpriced. I've sold I've sold two and have a third one in contract right now because I believe they're overpriced. One of them I did 1031 exchanges into a bunch of houses. The other one I had it structured where I'm not going to pay much tax on it given depreciation and loss carryover and all of that. So that raised my cash position significantly. And I actually sleep pretty good at night, knowing that I have enough cash that if a deal of a lifetime came across the table, I'd be fine. I'm not in a rush to put it there. I might want to look at putting it in 28-day treasuries. Right now, it's in a high yield savings account. It's enough money where I get nice rates. I think it's like 1.8% today, and I don't overthink it. And maybe that's wrong, but again, I've never had this kind of cash sitting around because I'd always, I had income before, right? I had W-2 income before. So I may have to look at how I handle it, but right now I sleep pretty good at night. Yeah, so I have cash, not T-bills or, yeah. So that's what I do.
I like that. I think it's helpful to hear other people's opinions on this. Like, I'd like to hear like some legendary real estate investors, how they think about this topic, because I think this is, it's nuanced actually. It's a simple question. Where do you hold your cash? How much liquidity do you keep? But it's actually quite nuanced, and it can make a big difference. Yeah. If you weren't cash, if you didn't have cash and there's bountiful opportunity in front of you, that's a big strategic mistake on your part, right? So I think it is important to like be a student of this question. It's I will admit I'm continuing to learn on this.
Yeah, I think that's the last thing on this, and we'll go to the next question. And the other thing I'll say is I expect my cash balance to be higher in December than it is today, and it's already higher than it's ever been. And I say that because I've been investing for 20 years. I'm getting all tingly because we're at or near the top of the market. I so think multifamily is overpriced, at least in small apartment buildings, that I think there's going to be plenty of opportunities in like 2023 when people start getting their rate and refi and term stuff. And they're going to realize that being a landlord of apartments is freaking hard and their stupid Excel spreadsheets are wrong. So I will have plenty of cash, probably 2 or 3x that I have now, heading into the end of 2021. I will be cash ready. I will be, in my world, I'll be Warren Buffett, right? Warren Buffett's sitting on $150 billion or whatever it is for him. I will have more cash than I've ever had by the end of 2021, because I'm going to sit down, and if it doesn't happen in 22, fine. If it doesn't happen in 23, fine. But it'll happen. I've been here before. So I'll just be sitting on the sidelines, just waiting and just waiting and waiting. And I think it's going to happen. So
I like it.
I like it. All right. This is fun. All right. Oh, this is a hot topic. Rent control in California, good or bad for investors? Oh my goodness.
Do you want to start?
Yeah. So I'll start. When I think about rent control, I actually did a bunch of research on this, and I looked at New York and San Francisco. I think without question, rent control, unless you're one of the very small percentage of tenants who benefit from it, hurts everyone. Because what happens is supply leaves the market. If you're in a building that can go condo, congrats, the owner's going to kick you out. He's going to go condo and sell it piece by piece. If you're in the lower tier, congrats, the owner's going to suck the building dry because he can't cash flow it anymore. He's not going to do
any improvements. They're not going to make any. Yeah, that's right. It's going to fall into disrepair.
Yeah. So how am I using this to my advantage? Because it is law now, right? It's not like it's theory. So I'm on record as saying the mom and pop investors, kind of my level, who own the kind of 5 through maybe 30 unit apartment buildings, right? The small stuff that you guys don't look at, right? The big boys don't look at. If you were mom and pop and you were keeping your rents low, like 20% under market, and eventually you're going to sell, the value of your building just took a 30% hit. Because before rent control went into effect, most investors would go, hey, well, I can just kick them out. I can raise rents. I can take it to market. I'll be fine. And I'll just eat the loss the first year. Nope. Can't do that now, right? You're capped out. Whatever the existing rents are, you're capped out at roughly 8%, right? 5 plus inflation. And, good luck getting, 30 people out, 90-day notices and paying moving expenses and all that stuff. It hurts existing landlords who have not run a good business. All of my units, I have never raised rents more than 8% in a year. So it doesn't affect me at all, right? It's only going to create opportunity, and it will create opportunity over the next couple of years. It's one of the reasons I'm raising cash. To the last question is because mom and pop investors will start to sell more and more stuff. It happens every year. and they're going to realize that their stuff's not as valuable. And, they're eventually going to have to find somebody that's willing to take the heavy lift. And, I have enough infrastructure and team and long-term vision where I can still tackle projects like that. So I think it really, really hurts tenants because we have an affordability problem in California. This is only going to exacerbate it. New construction on apartments is going to be lower. Quality landlords are going to be less. Slumlords are going to be more. It's just a horrible outcome unless you're one of the tenants who gets to live in a 3-bedroom, 2-bath in San Francisco for $800 because your mom gave it to you when she died. There are people that win, but I believe it hurts the majority of people. But again, I always look at a situation, how am I going to take advantage of it? And I'm going to buy a bunch of under-rented multifamily properties over the next 1 to 3 years because they are frankly not worth as much as they could be. That's what I'm going to do.
Yeah, I think that's astute. I mean, in general, I agree with you. I think rent control in general is not great for the market. This has been studied and proven by economists. There's lots of, Google this. This is pretty
independent economist. Exactly.
Yeah, so and intuitively, as you lay it out and like think about it logically, it makes sense too. It works for a small percentage of tenants, and for the majority of people, it's not really an effective strategy.
Mm-hmm.
It's not going to solve the housing problem in California. Definitely not.
No. It's make it worse.
As investors, our job partially is to understand the world and figure out how to profit from it, right?
Yep.
And so we don't do a lot in California, partially because it's a tough state to do business in. It's a tough state from a landlord perspective. Mm-hmm. But there are tremendous opportunities in California if you know what you're looking for, and you have a very, very concrete, like specific investment thesis. So I'll give you an example where this might be an opportunity, and one thing that we're looking into right now. Mm-hmm. So if you look in an extremely supply constrained market, so like Santa Barbara, California, 2% multifamily vacancy.
Wow.
Okay, there's just nowhere to build anything. The city has very strict building ordinances, and it's very expensive to build there. Yeah. So there's lots of the supply demand imbalance is heavily tilted in the favor of there's lots of demand, there's not a ton of supply. Okay. So in a market like that, we might look at purchasing a multifamily property from maybe a mom and pop investor who inherited a building from mom or dad. Mm-hmm. And like you said, they don't have two things. They don't have one, the kind of the knowledge or sophistication of understanding here is the landscape, the regulatory and legal landscape, and I understand it in a very sophisticated way. They don't have that. Yep. And number two, they don't have, even if they did understand it in a sophisticated way, they don't have the ability or willingness to go execute what needs to be executed in order to property. Neither of these are the faults of that mom and pop owner or investor, right? Mm-hmm. It just is how things play out. So what we are looking for are there opportunities to buy that multifamily property that you talked about at a 30% discount, and then execute a business plan that takes advantage of that supply-demand imbalance, and do it in a slightly more sophisticated way than the previous owner knows how to do it. Yeah. And the beauty of if you can execute that plan well is cap rates in California are so low, and especially in these supply-constrained markets, that every dollar of NOI or cash flow that you incrementally generate at that property provides a really, really meaningful amount of value to the property that you can eventually sell.
Oh, yeah.
So that's a strategy that I'm personally looking at in California, in one way where rent control might actually help because it provides a slight haircut to the purchase price.
Exactly.
And we might be able to take advantage of that opportunity.
Yeah. So so it's funny that we have the same thesis. You're operating a scale beyond mine, but it's essentially the same thesis. I believe what I'll just call value add multifamily is going to see haircuts as we roll forward. Now, the law's only been in effect for, I don't know, 6 months or whatever it's been. So I believe the opportunities are going to start to trickle in kind of the late part of this year. Because again, just life events need to happen, right? Right, so-and-so needs to pass on or whatever. And those deals will start to hit the market later this year. Because anything that comes on now, it's too soon. They're going to still rely on the prices are sticky on the way down, right? They're going to look at, hey, my neighbor sold it for 4 cap, and anyways. So I think that's gonna be.
I think that's right. There's going to be a period of kind of stalemate where you have pricing expectations for sellers that are still really high, and pricing expectations for buyers that are a little bit lower. That gap is going to have to close. It's going to take a little bit. I agree. It'll take a little bit of time.
We're in that window right now. All right, this is the last question that we have, and it's one that I've been thinking about a bunch because I own a bunch of houses that I will probably do this on, and that is California ADU opportunity. New laws just became effective Jan 1. What do you think?
Okay, this is a great question. This is another attempt by the legislature to try and resolve this major California housing crisis that we're in.
No question.
Basically, just like recapping this law, ADUs are accessory dwelling units. It's basically a granny or in-law unit on the property adjacent to or connected to a single-family home. Mm-hmm. So I think it's AB 1482. California just passed this bill January 1, which says the state is no longer, the state has mandated that cities allow people to build ADUs on any single family property. Mm-hmm. They have to follow certain guidelines, but the city or the county no longer has the authority to override the state level ordinance. Yep. So basically, this is kind of like people are calling this the end of single family zoning. Anyone can take a property that they own and build an in-law unit or a granny unit or an mm-hmm. ADU. So this is really interesting, again, I think, in extremely supply constrained markets and markets where land costs are really, really high and rents are really, really high from an investor's perspective.
Yeah.
So for instance, I live in Los Gatos, very, very high cost of living, right? High land prices, high median home prices. You could probably build an 800 square foot in-law unit, a 1-bedroom, and you might get $3,500 a month to rent that. Exactly. So it's a simple, it kind of comes down to a simple math equation of how much does it cost me to build this ADU? How much income can I generate from it? Is the ROI sufficiently high enough that it makes sense from a cash flow perspective? Or if I have a sale, kind of a more quick, kind of a flip mindset, then is the eventual sale price, does that justify the investment it takes for me to build this ADU? Mm-hmm. I think it will in many markets that are supply constrained and that have high rent and
You there?
Yeah, sorry, did I lose you?
Yeah, I did just for a sec. We're good.
I think it will in markets that have high cost of land, high rent, and that are supply constrained. I think people will make money as investors building these things.
Yeah. So first and foremost, what my thoughts on it is, I hate to say this, but I don't agree with much that goes on at the whole Gavin Newsom level. I think he's a socialist or whatever, but I think this is going to help. I think this is a legit attempt. It will create more supply. And, I think it'll usually things like this help at the margins. I think this is going to be bigger than just the margins. I think this will absolutely help. But the other thing that's going to happen is once people try it, like your next door neighbor did it and your next door neighbor's, dog walker did it, it is going to create a construction boom. So cost to build is going to go up because supply of, contractors this is going to create a building boom in high price markets like Los Gatos and Cupertino and Orange County and, wherever. And I think it's going to be net good. It's another reason I think the economy is going to be strong. It's another reason I think California is going to be strong. I think there will be a whole generation of flippers who all they do is they go buy older homes. They overpay in the beginning because they know their plans include an ADU in the back, and they're going to not only flip the front but flip the back. First movers are going to have an advantage. I'm very happy to own a lot of single-family homes on full-size lots in Fresno, California that will eventually all have ADUs, I am sure. I liked it. I'm going to read a lot of it because I think that there's obviously setback rules and things of that nature. So I got to get clear on them. But I think the ADUs in California, assuming what I know about it today, what AB 1482 is, it's going to help. I think it's a good thing.
I think that's right. That's an interesting point about the building boom. I think that's legitimate. I also think that this is going to be a great opportunity for the modular prefabricated.
Exactly. That's what I'll be using.
Well, yeah, because you basically get a box delivered to your property, and 2 weeks later you have a fully furnished, installed, finished out unit. And that might be a little bit, you might pay a premium for the actual, wood and steel, but you're getting a finished product very, very quickly. So I think that's going to be an interesting trend to watch too.
Yeah, I mean, I'm already working on this, right? We're taking one of our properties because, again, you just never know until you do it once. So I have a particular property that's perfect for it, right? It feels like two city lots. One house, it's set back really far on the lot, so there's like, look at all that land right there. We could plop a house down right there. So we're currently trying it out. My plan is to create an approved, plan, right? Which the city is supposed to rubber stamp, but again, I'll believe it when I see it. And I'm just going to rinse and repeat over. I'm not going to get creative, man. It's going to be the same freaking design every single time.
Yeah.
If I can buy it on Amazon, believe me, I will. I don't, I'll get credit card points or something, man. It's just going to happen, but I'm going to call me suspicious, but I'm going to try it once. And if it works, if you know my story at all, if it works once, I'll keep doing it because I'm very simple. So that's my plan with ADUs.
Yep. Awesome.
Well, very cool. Go ahead.
I was going to say, I'll be following I'm interested to follow your progress.
Yeah, I will. I'll be posting.
I think it's an exciting opportunity.
Yeah, very cool. Well, Matt, this has been so much fun. I appreciate you bringing us home, man. You're a great cleanup hitter. You nailed it. I think getting and answering all these questions is going to be awesome. So I look forward to next week. How can people follow you, reach out to you, see what you're doing?
Drivencap.com. You can email me, Matt@drivencap. And appreciate the opportunity, Michael. Look forward to it next time.
All right, buddy. We'll talk next Thursday at 8:00. Enjoy your day.
All right. Take care.
Yep.